Welcome to this episode of Mo Money. I'm Alexander Paul Morris, your host. In 2004, Ed Lampert made over $1 billion, while his fund, ESL Investments, raked in a 69% return, largely due to the merger of Kmart and Sears. Hedge funds are private investment firms that cater to a millionaire clientele and pay sizable fees to the managers. The typical hedge fund formula is 1 in 20, meaning the manager collects a fee of 1% of assets plus 20% of all profits. Some particularly successful managers have received fees as high as 50% of profits.
Wow.
Of course, since the bulk of the fees are based on profits, hedge fund managers also stand to make very little if they do not continually churn out performance well above the averages for their niche. In actuality, the fees really don't matter so much, as does the quality of the manager and the strategies being pursued. If a fund can generate an above-average return after fees and taxes with a level of volatility that you're comfortable with, that's what's most important. And also be sure you understand the strategies being pursued and how much leverage may be used to generate the returns being described. For example, if a fund is telling you that their PIPE strategy, and that's private investments in public equity, is able to return 50% annually, however, other funds pursuing the same strategy are only able to return 15% per year, you'd better understand how the fund's generating such a substantial edge. Make sure their only real talent isn't playing with numbers on a ledger. Because fund managers are always on the spot to perform and get paid for both performance and funds under management, there's a big incentive to find ways to make returns look better than they really are.
Ouch.
Even if hedge funds were eventually to be regulated, it would still not be any substitute for in-depth research and due diligence. I recently read the book Hedge Hogging by Barton Biggs, who worked for A.W. Jones and Company back in the early 60s, otherwise known as the first hedge fund. He and some partners ran their own successful fund, Fairfield Partners, from 1965 to 1973. From there, he spent 30 years building Morgan Stanley's research department and investment management divisions before forming Traxys Partners with two other colleagues in 2003. Traxys now manages well over $1 billion and has also achieved respectable returns since inception. Hedge hogging not only provides a fascinating glimpse of the investing world, but also provides an insightful look at the history of hedge funds and the strategies they deploy. It also provides insight into what it takes to be a successful investor and how important it is for investors to see one step ahead versus most others who merely respond to what's going on now. In the book, he discusses his own experiences, good and bad, and the wisdom he's collected from all his years in the business. Some great quotes from the book include a paraphrase of John Maynard Keynes by Biggs, his father, describing market behavior. Unfortunately, the markets can remain irrational longer than you can remain solvent. No matter how great the investor, properly managing losses is always of the utmost importance for investing survival. On page 260, he presents a very interesting view of market bubbles. When a bubble in non-productive assets financed by banks bursts, the consequences invariably are deflation and depression. The tech bubble of the 1990s was in a highly productive asset, and it was financed by stocks and bonds, not the banking system. So its aftershocks may be relatively minor. To make this a bit clearer, figure that one main consequence of the tech bubble was the huge investment in internet infrastructure, which led to reasonably priced internet access for all. During the Japanese bubble of the 80s, what productivity gains were achieved from banks financing $50 million purchases of art or land at overinflated prices? Japan still hasn't fully recovered. This goes hand in hand with another great quote from page 259 by Seth Klarman of the Baupost Group, a $5 billion fund. People don't consciously choose to invest with emotion. They simply can't help it. After reading this book, I felt compelled to recommend it, as it seemed to bring together and reinforce so many points that I myself would want to convey to anyone interested in trading, investing, and hedge funds. For accredited investors who have the means and are interested in hedge fund investing, page 222 has a great outline of what to look for under the heading of Think of Returns Net After Fees and Taxes. Most hedge funds are, quite simply, not worth the additional risk and fees versus the potential return. There's no real edge offered. However, investing in a solid fund of funds that has the means and know-how to constantly research new strategies and managers, perform ongoing due diligence, and diversify among a broad range of unique high-quality strategies can be an excellent alternative investment. The hedge funds that I myself have become involved with pursue this exact strategy. The goal is to invest in niche-oriented off-radar strategies such as electricity arbitrage or environmental credits trading, unknown or inaccessible to most investors, that have the potential to generate attractive, low volatility returns in a fund of funds capacity. So how's that for looking one step ahead?